Hey everyone, last week we got the June CPI inflation data, and I have some good news and some not so good news. The good news is that inflation went down by 70 basis points to 3.5% last month. That was largely based on lower oil and gas prices amid a ceasefire in the Middle East conflict. The not so good news is that the Middle East conflict is heating up again and oil prices are once again moving higher. That suggests that despite the brief reprieve we had in June and probably July, we're not out of the elevated inflation cycle yet. The challenge is that at this point, there's no clear off-ramp from the Middle East conflict. And as a result, even though there may be intermittent pauses in the conflict, the flow of oil through the Strait of Hormuz could remain restricted for a prolonged period, and that would likely result in an extended cycle of elevated energy prices, which in turn could sustain inflationary pressure. Other inflation metrics like food, housing, and medical care have comparatively low inflation in the 2 to mid 3% range. Core CPI inflation, which strips out energy and food, is stable at just 2.6%. But higher oil and gas prices, which bleed over into transportation costs, could keep headline inflation elevated. And high inflation increases the probability the Federal Reserve will raise interest rates. Although several members of the Federal Reserve are resistant to rate increases, the current probability of a rate hike by the end of the year remains above 70%. And for commercial real estate investors, while this isn't positive, it also isn't unexpected. In large part, the risk of potential rate increases is already baked into Treasury rates and lending rates. And because they're already baked in, the cost of debt capital should remain relatively stable. And while a sizable buyer-seller expectation gap remains, at least the risk of transactions being derailed by significant interest rate volatility is diminished. Since the fourth quarter of 2024, the 10-year Treasury has largely been range-bound between 4 and 4.5%, and cap rates for most property types have largely calibrated to meet the market at that interest rate range. Although the margins can be thin and underwriting deals can be difficult, investors can still find opportunity. But when investors dial back the lens and look at the bigger picture, the commercial real estate thesis strengthens considerably. If the US faces an extended inflation cycle, commercial real estate is one of the few investments that offers some inflation resistance. In addition, based on our preliminary read of the second quarter commercial real estate fundamentals, despite elevated uncertainty, despite the Middle East conflict, and despite tariff-driven headwinds, all four of the major property types are generating positive space demand. Office properties delivered a 9th consecutive quarter of positive net absorption, lowering the national office vacancy rate. Apartment demand exceeded expectations, also pushing vacancy rates lower in the second quarter. And retail and industrial space demand remained in balance with new construction, keeping vacancy rates stable. In spite of the headwinds, commercial real estate continues to gain ground. And if a resolution to the Middle East conflict comes to fruition, inflation could abate and economic momentum could strengthen. In turn, that could bolster commercial real estate fundamentals. So, as investors look forward, they have to consider the durability of commercial real estate and its inflation resistance. Then, when the economy shifts gears, the sector could be invigorated. That ability to withstand inflationary pressure and other headwinds, together with the prospect of upside potential, is key for investors who keep their eyes on the horizon.